Hello guys, this is Ben K from Kapital. Today I'll be sharing with you about the topic that trading is all about probabilities. And before we continue, let me just read you the risk disclaimer. Trading in financial instruments involves a high degree of risk, and this can lead to loss of some of or all of your investment capital. And this presentation is for educational purposes only and not investment advice. Never invest capital you cannot afford to lose. Okay, with that out of the way, let's get to it. So we're going to take an example of a 500 US dollar account. Somebody, let's say they have $500 on their account, and when we say that trading is all about probabilities, this is what we mean. Okay, let's take for example that it's two guys. One risks 1% of the account balance, that is of $500, and the other one uh, doesn't stick to proper risk management. They risk 10% of the account balance. Okay, and for the first guy, his risk to reward is 1 to 3. It means he's risking 1% to gain 3 times. And the one who is risking 10%, their risk reward is 1 to 1. They risk 1% to gain 1%. That's what it means. And when you risk 1% of the account balance of 500 for the first guy, it means they're going to risk $5 per trade. And for the guy risking 10% of $500, it means they are risking $50 per trade. That's what it means. So it means provided they took the first trade and they lost $5, risking 1% for the first guy, it means the one who's risking 1%, they have 99 losing trades to blow their account. It means it will take them 99 losing trades for them to reach their balance to reach 0. 99, which is less likely to happen for somebody to have a streak of 99 losing trades. Highly unlikely. Okay, so for the one who's risking 10%, it just means because 10% of $500 is $50, it means they have, provided they took the first trade and they lost the 50, it means they are only remaining with 9 trades. So it means it will take them 9 losing trades to blow the account. So I'm going to just assume that they are taking 10 trades. So those numbers 1 through 10, just the number of trades they took. So what I want to emphasize is that no one knows the sequence. By the sequence I mean of winning or losing streaks. You see, I just colored this from 1 to 5 red, 6 to 10 green. Red for loss, green for wins. So this is just a typical example. By this 5 losses and 5 wins, it means 50-50 chance. But let's take it a bit further. Okay, let's assume, since I told you no one knows the sequence, it can happen in this way, like I put it here: 5 losses in a row and 6 wins in a row. Okay, so 1 to 5 are losses, 6 to 10 is the wins. So okay, using the concept of risk reward, like I said, for the first person who's risking 1%, their risk reward is good because they're risking 1% to gain 3 times. So as we look at here, let's take for example for this guy, the one risking 1%. What it basically means, using this sequence I put here, so it shows me that from 1 to 5 trades they were all losses, so they lost 5% since they are risking what, 1%. So here, if this goes to loss, they lost 1%. In monetary terms, that's $5. So 5 times 5, that's like $25 gone for this guy. So for this guy who's risking 10%, 50 times 5, that's almost half of the account. 50% is gone. $250 is gone. That's what it means. So okay, like we said, they lost 1% from the first trade to the fifth. It's all losses, but because of the concept of risk to reward, we can say, because this person risking 1% is a good risk to reward, it means on the 6th he got a profit of 1%. They booked 1%, so they risked 1% to gain 1%. That's what it means. On the second trade, we are on the wins. They risked 1% and they managed to gain 2%. Eighth gained 1%. Third gained 3%. So here on the ninth trade, it's more like the risk to reward they put, risking 1% to gain 3 times more. So on the 10th trade, because this is just the baseline, the minimum you can get from a trade. So if you are using like a trailing stop or locking in your profits, riding the trend and stuff, it's possible to gain more than your risk reward. This is like the minimum, because this risk reward is based on your strategy that you are using, the kind of trader you are using. So on the 10 trade, they risked 1% and managed to book 5% more. So when we add the wins, they give us 12%, and when we add these 1% losses, that's 5%. So the net profit, 12 minus 5, they managed to book 7% from this. They managed to book 7% from these 10 trades. So that is the power of probabilities and good risk to reward ratio coupled with proper risk management. Okay, so going back to probabilities, this one risks 1%. It means they have like 100 trades left if you are using 1%. For the one risking 10%, they have like 10 trades. That's what it means. If it goes against them, they'll blow the accounts in 10 trades. For the one risking 10% and the one risking 1%, they'll blow the account within 100 trades, which is highly unlikely. But for this one, risking 10%, it's highly likely. Yeah, they can blow in within 10 trades. It's very possible, because like I said, no one knows the sequence. So this was just a typical example, because the sequence can be 1 to 9, all losses, and you win on the 10th one. So because of the power of the probabilities, so if you are using proper risk management, you can give yourself an edge, a trading edge, a winning chance. So as compared to this guy, he's limiting himself, because he will be out of the game very, very soon because of not using proper risk management, and his risk reward is very low, and they're risking a lot. So that's what it means. So I'll leave you with a quote from one of the greatest traders, Neil Fuller. He said, once you begin to realize that any given trade has an equal chance of being a winner or loser, you will stop giving too much emotional and financial importance to any one trade. Once you do this, it opens up the pathway to carefree trading and allows you to truly induce the proper trading mindset. So basically what he's saying is that it's all about probabilities. So every trade can either be a win or a loss. That's what it means. So since we don't know the sequence, we don't know whether the first trade gonna be a win, the second gonna be a win, and so forth. We don't know. So it's all about trading. It's all about probabilities. So for you to use probability in your favor, you need to use proper risk money management. So stick to a small percentage, and we recommend at BSK, at Brown Swiss Capital FX, we recommend you risk 1% of your account balance. That's what we recommend. So you are using probabilities in your favor rather than against you. And you can contact us on Telegram, and there's a link for the admin. We have a Facebook page which we recently published, so give us a like, follow the page, share the page, show us some love. And our email at brownswisscapital@gmail.com, and the website and contact details are there. You can get in touch with us.